Hello there, Hector Davil here. In this final video, I just very briefly want to bring your attention to three important details. First of all, how do we deal with stop loss trailing? Where and when or how do we trail our stop loss? In case you're not familiar with the stop loss trailing, that basically means to move your stop loss up once your trade is already in profits, okay, in order to offset the risk out of the trade. So should price turn around, you will be stopped out at break-even and therefore you will lose no money, okay. That's basically what trailing your stop loss actually is. The problem with the stop loss, with trailing your stop loss, is that you need to do it at the exact time. Otherwise, if you trail it too quick, well, any random wiggle, any random random market noise in the chart will simply knock your stop loss out, and therefore it will knock you out of the trade without giving the trade a fair chance to perform. Okay, so you want to give the trade a fair breathing room. The way I deal with my stop losses is to base my stop loss trailing milestone around the previous swing high. So as I cash out a portion of the trade, 50% of the trade, just before hitting the previous swing high, as I close out those lots at 50% of my lot size, I trail my stop loss to break even. Okay, and that's it basically. That's the way I deal with the stop loss, with trailing my stop loss. I don't really trail my stop loss as price hits the projection bands. I don't really find it necessary. Maybe as price hits the second projection band, you may want to, as price hits your first target, your stop loss goes to break even. Well, break even plus the spread, to be more accurate. Okay, as price hits the first band, I personally don't take any action whatsoever. As price hits the second band of the of the target projections, I may decide to trail my stop loss up if I see that there is enough breathing room. Okay, if I see that there is plenty of space in between. So even if price just randomly wiggles a little bit, it will not knock my trailed stop loss. It's impossible to determine a specific amount of pips. So for example, let's say if price is, at plus 60 pips in profit, you will trail your stop loss up to plus 20. All right? That's just impossible because, as you probably know, some currency pairs are more volatile. Okay, they move farther, a larger amount of pips. Also depends on what time frame you are taking your trading decisions. Okay, so again, it's really difficult to give you any exact amount of pips. It's something that you will have to gauge from a visual point of view. So if there is enough breathing room by the time price hits your second projection band, then you are okay to trail your stop loss up a little bit, maybe all the way up to the first target, again should you have enough breathing room. But at any rate, the most trailing milestone is the previous swing high. Okay, so once again, as you score those profits there, you simply trail your stop loss up, and that's basically it. All right. Should price move down and hit your stop loss, you will have scored these many pips in profit on the first half of your trade, on the first 50% of the trade, and you will score no loss whatsoever on the second 50% because your stop loss is sitting at break even. Okay, so as you hit your first target, or at least the target related to the previous swing high, you've completely 100% offset the risk out of that trade. All right, and that's always a good thing. All right, next up, your entry needs to be close to the bounce point. All right. If by the time, let's imagine this is the former swing, okay, and a whole new swing is taking off, but if by the time you get your entry signal price is closer to the previous swing high than to the actual bounce point, all right, just simply, calculate this distance, mark the 50% range. Well, if your entry comes, let's say there, that's a trade you cannot take from a money management point of view, okay, or rather from a risk management point of view. Please mind that if you enter your trade there, the distance between your entry and your main target of reference is smaller than the distance between your entry and your stop loss. Basically, you will be risking this many pips in order to shoot for these many pips. I mean, sure, you can always argue that you are also shooting for further profits at the projection bands, right? But please remember what I mentioned on a previous video. The farther up you are in the swing, the higher the chances that price will turn around. That means that the lower the chances that the outer projection bands will actually be hit. Okay, so chances are you will indeed hit the first target, but you never know whether you will hit the outer projection bands, right? So you cannot really justify taking that trade. Again, let me draw that range and mark the 50% range. So the 50% mark. So you cannot really justify taking any trade beyond the midpoint, that 50% limit, so to speak, because then you will be trading with a negative risk-reward ratio. Again, you will be risking this many pips in order to shoot for this many. That's never a good idea. So my rule of the thumb is, again, the distance between your entry and the bounce point, okay, the bounce point there needs to be smaller, right? Needs to be shorter than the distance between your entry and the previous swing high. In a nutshell, the entry needs to be closer to the bounce point than to the resistance area ahead of your trade. Okay, guys, that's an important rule. Don't forget it. And finally, and this is also an important one, okay? Do not trade the first bounce of the dynamic area of support and resistance. That means that on the first bounce of the trend, you do not want to trade that bounce. You want to wait for the second bounce onward. And that's kind of a definition thing, all right? I mean, from a definition point of view, the trend doesn't start or doesn't confirm until the second bounce onward. In the same way that you actually require 2 bounce points in order to draw a trend line, okay? You cannot really draw a trend line if you only have one single swing point, okay? Because you would have basically, an endless amount of trend lines, right? You actually require 2 focal points so you can actually draw that trend line. Well, this is pretty much the same thing. The trend is not so until you get a second bounce of the dynamic area of support and resistance. Okay, and let's go back into my charting platform. As you can see, I've already showed you guys this example, okay, on the USD against the Swiss franc on the 4 hours time frame. This is a typical trend. As I go back, we can see that the trend starts more or less around there. All the 3 moving averages get in order, okay, 30 above the 50, 50 above the 100, all of them begin to point up, and the indicator begins to print the dynamic area of support and resistance, right? Well, there we have our first bounce, right? Our first bounce. This is the first swing of the trend, and that's the first pullback. Well, that's not a trend yet. That's the first bounce of the dynamic area of support and resistance. You do not want to take that trade. Again, the trend still has not confirmed from that point on. At this moment, the only thing we have is just one bounce. One bounce means no trend. Okay, one bounce indicates no trend yet. It's just one single swing, right? We require 2 swings for a trend. So you could take this bounce there, you could take that bounce there. Okay, this is a valid trading opportunity, that's another valid trading opportunity, this is not a valid opportunity. Okay, again, because at this point, I'm sorry if I am beating a dead horse here, but at this point we have no trend yet, we just have one single swing. Okay, we require a second swing, and from there that's where the trend starts. Okay, that's where the trend is confirmed, so that's a valid trading opportunity there, and that's another one there. Alright, let me now show you another example. Just because it's a downtrend, I want to show you examples both on uptrends and downtrends. As I scroll back to the beginning of this current trend, as you can see, price has certainly been zigzagging down, okay, with the moving averages nicely pointing down, etc., etc. The trend more or less begins around that area where the moving averages fall in order and the indicator begins to core the dynamic area of support and resistance. Well, here's our first swing, and that's a bounce you cannot take because it's the first one. You can indeed take bounces from the second swing onward, meaning there. All right, that's a valid entry. Another swing, another bounce, another entry, another swing, and so on and so forth. Okay, as long as you don't trade the first retracement to the dynamic area of support and resistance, you're okay. Please, guys, remember this rule, it's an important one.